Ever wondered about the investment secret of Peter Lynch, the legendary investor who managed Fidelity's Magellan Fund? Let's turn back the hands of time to introduce you to this financial titan. Lynch honed his financial acumen at Fidelity, where he managed the Magellan Fund for over a decade, from 1977 to 1990. His tenure saw the fund's assets grow from $20 million to $14 billion. Lynch's success can be attributed to his unique investment philosophy and approach, which we will explore in detail. At the heart of Lynch's approach is a simple yet powerful concept: invest in what you know. Lynch champions the idea that ordinary people have a distinct advantage over Wall Street professionals. Why? Because they interact with products and services daily, thus having first-hand knowledge of what's working and what's not. This philosophy is rooted in the bottom-up approach, where investment decisions begin with an individual company's analysis rather than the economy or industry trends. Lynch believes that when you understand a business, you're more likely to spot opportunities and less likely to be thrown off by market fluctuations. He encourages investors to look closer to home, to their fields of expertise or even their hobbies. The companies that make your favorite products, the ones you can't live without, might just be your next big investment. For Lynch, investing success starts with understanding and capitalizing on what you know best. Another cornerstone of Lynch's philosophy is the story approach to investing. He believed that investing is not just about numbers, but about understanding the narrative behind a company. What's their vision? What's their growth potential? Lynch preferred companies that were familiar, or had products or services that were easily understandable. He found value in the everyday, in the companies that created the products he used and the services he relied on. In Lynch's words, the best investment you can make is in a company you already know and trust. Lynch's meticulous selection process and specific criteria are key to his investment success. He emphasized the importance of thorough research and analysis, not just relying on financial metrics but also understanding a company's plans for future growth. He believed in digging deep, going beyond the surface of a company's balance sheet to truly comprehend its business model and potential. Key metrics that Lynch urged investors to examine when evaluating stocks include year-by-year earnings, price-earnings ratios, and debt-equity ratios. These figures can provide a snapshot of a company's financial health and its potential for growth. But he didn't stop there. He also looked at dividends, inventories, and other factors that provide a more complete picture of a company's operations and financial standing. Crucially, Lynch's approach was not just about numbers. He wanted to understand the company's story, its products or services, and its place in the market. By understanding a company's financials, plans for future growth, and unique story, Lynch was able to make informed and successful investment decisions. Building and monitoring a portfolio is an art, and Lynch had his unique style. His approach was built on long-term commitment to the stock market. He wasn't a fan of rapid-fire trading or hopping from one hot stock to the next. Instead, he believed in sticking with investments for the long haul, allowing them to mature and grow. Over-diversification was another pitfall Lynch cautioned against. He advocated for a focused portfolio, where each holding is well understood and carefully chosen. Regular review of these holdings was also essential to ensure they still aligned with the investor's objectives and the company's growth story. Highlighting Lynch's perspective on selling stocks, it wasn't about market timing or panic selling. Instead, he suggested selling when the reasons for buying no longer hold true, or when a better opportunity presents itself. For Lynch, a well-managed portfolio wasn't just about buying stocks, but also knowing when to hold on to them and when to let them go. So, what can we learn from Peter Lynch's approach to investing? Lynch's philosophy, rooted in the principle of investing in what we know, underscores the importance of understanding and familiarity. His approach has shown us that every investor, regardless of their level of experience, has the potential to identify valuable opportunities that even Wall Street professionals might overlook. Lynch's meticulous selection process and his categorization of companies into distinct types based on their growth potential and characteristics offer a structured way to approach the vast and often overwhelming world of investing. Moreover, his emphasis on thorough research and analysis, as well as understanding a company's prospects for future growth, underscore the importance of due diligence and forward thinking in successful investing. By adopting Lynch's strategies, we can make informed and confident investment decisions, built on a solid foundation of understanding and insight. As Peter Lynch once said, invest in what you know. This simple yet powerful philosophy can guide us all towards better investment decisions.